Hi, everybody. Welcome to the Patty Brennan Show. Whether you have $20 or $20 million, this show is for those of you who want to protect, grow, and use your assets to live your very best lives. Joining me today is Brad Everett. He's our Chief Investment Officer, and we're going to be talking about stocks and bonds. And specifically, is the traditional relationship between stocks and bonds, is that broken, never to be seen or benefited from again? So before we start, I'm not going to make the assumption, Brad, that everybody understands what a bond is and what a stock is. It sounds really fundamental. I think it's really important, especially given the topic that we're talking about today. So can you explain to our listeners what's the difference between a bond and a stock?
Yeah, I think we could make it a lot more complicated, but I think, at the very basic, a bond is debt, right? A company borrows money and then agrees to some repayment plan, which, you pay back the original amount that you borrowed, and then there's some additional interest cost. The cost to the borrower, that interest, is the income to the lender, the person that, funded the bond or lent the money. And then, some loans cost more than others or have a higher interest cost than others. The interest could be based on several things: credit quality of the borrower, the duration of the loan, general market conditions, interest rates, inflation, supply and demand, all these things that kind of factor into whether it's cheap for this company to borrow or more expensive. Is the interest rate low or is it high? And the value of the debt itself can change based on any changes in those factors that occur while the debt is outstanding.
Excellent. And so basically bonds, if I've got a $100,000 bond out there, I have lent, for example, IBM $100,000.
Yep.
And if it's a 30-year bond, over the next 30 years, every 3 months, they're going to pay me some interest. And at the end of that term, they're going to pay me my money back, my $100,000 back, right?
Yep.
Okay, so that's called par. When you get the same amount that you lent to them, you get par. So, and there's different types of bonds, right? So you could lend money to the federal government, right? That's
Sure.
that's a treasury.
Yep.
What other kinds of bonds are out there?
There's local governments, so you could, municipalities, toll roads, things like that, for local building projects and things like that. But foreign governments, foreign corporations, all kinds of things. So.
And the interest rate that you would get is based on those factors that you mentioned earlier, and basically the creditworthiness of the company or wherever you're loaning it to, right?
Yeah, that's part of it, right? So if IBM is struggling with cash flow, their business prospects aren't good, maybe you want a higher interest rate because of that. If they tell you they're going to pay you back in 2 years, maybe you would demand less of an interest than them saying they're going to give you your money back in 10 years. So there's lots of things that can go into that.
Okay, so sounds good. So, all right, so why the bond market we were talking about earlier before we started, the bond market is so much bigger than the stock market. A lot of people don't realize that. And bonds get traded a lot more than stocks do. So let's talk about stocks for a second, because that sounds kind of good. I get money all along the way, and then I get my money back. What could be wrong with that? And by the way, depending on the type of bond, that interest you get could be tax-free, right? If it's a municipality,
Right.
If it's a treasury, it could be state tax-free, et cetera. So there's income tax considerations as well. What about stocks? Why stocks? What's the benefit of that, owning a slice of IBM or another company?
Yeah, so that is the difference, right? So with debt, you own a slice of the debt and you are entitled to some kind of repayment. A stock actually gives you a small slice of ownership in the company itself. Ultimately, the stock owner is entitled to the earnings of the company. You don't get that on a monthly basis. Normally, there's a board of directors or a management team that chooses what to do with the earnings, right? Either they pay it out in dividends, they reinvest it in the company in the form of earnings, investing it back into the business. If you're going to reinvest in the company, maybe you have an idea that you can improve operations or capacity or efficiency or something like that, theoretically with the goal of increasing earnings over time. So as an owner of the company, you don't get your earnings, they put it back in the company, but if they do a good job of reinvesting, the price of the stock should grow as earnings grow because of the improvements to the company. So that would be the kind of the idea of owning a stock.
And, you know, we toss around these terms, growth and value. So what you've described, if they're reinvesting those earnings, which it's all about the earnings, right? So if they're reinvesting their earnings back into the company, the idea there is that they're going to grow in such a way to have even higher earnings down the road, so the value of the company explodes,
Right.
which is a growth company. A value company would be one that, you know what, we're just going to pay those earnings out to our shareholders in the form of dividends. Dividends are taxed at a more favorable rate than, say, a bond might be. And, you know, the stock's going to do whatever it does.
Yeah, they might have a great product that they sell a lot of right now, but they don't, see internally opportunities to reinvest in the company. Maybe they don't have any ideas for bigger growth projects, so they just say, all right, well, we made $100 selling such and such at the grocery store, so we'll just pay all that back out to the investment.
And something you said is really important. It's really up to the board of directors to make that decision. For example, when things aren't going so hot, for example, Boeing, right? Boeing is going through some rough patches here. They suspended their dividend. They're not paying anything when they were historically paying a dividend every quarter. When a board of directors suspends or decreases their dividend, what happens to the stock price?
I guess it depends what the market believes is the reason. If they think it's because a sign of struggle or lack of cash flow, it would be, I would think, detrimental to the business. In
Exactly.
most cases, yeah.
And a company like that has suffered as a result.
Right.
Now, here's another question. We didn't plan on getting into this, Brad, but I'm going to put you on the spot.
Sounds good.
Why in the world would you ever invest in a company like that when the stock has gone down and they're not paying a dividend? What would be the benefit to the person who is investing in, a value company? That's a term.
Yeah, I mean, I guess you would have to agree. You would have to believe that the price is already adjusted to account for the bad news, right? If if the market has accounted for all the problems, and you think the future value of the business is worth more than the current stock price, then that it could certainly be a great investment.
You just brought something up that's really interesting to me. At the end of the day, the market is a market, just like real estate or any market. It's just a bunch of opinions.
Yeah.
And the fact of the matter is, and you are a mathematician, you're a whiz when it comes to these things and numbers. At the end of the day, those decisions are based on whatever they believe, and they're going to invest accordingly. Some people believe that the stock is going to continue to go down and want to sell it. Some people think, oh, man, it's bottomed out. I'm going to buy low because, hey, it's a great brand. They own the market. There aren't many competitors, and eventually they're going to figure it out.
Right.
So those are opinions, and that's basically influencing the price. Here's a question I'm asked a lot. Why are bonds considered less risky than stocks?
Yeah, so a bond is a contract, and the company's obligated to pay that back first, right? The shareholders have nothing until the debt is paid off before. So if something happens, in your example of an IBM bond, if IBM goes bankrupt, anything that happened as they sell off their equipment and products and things like that they have left over, all that money would go back to the bondholders first, and the stockholders would probably have zero.
Isn't that interesting? And that's exactly what we saw during the financial crisis with General Motors, right? A bankruptcy judge made the decision and paid off the bondholders first, but not all of their money.
Right.
And stockholders got nothing.
Yeah.
They got nothing. And then they did their stock, and here we are today.
Yeah, but the opposite's true too, right? You would never pay the bondholder more than the very minimum that you're obligated to pay them, and then as long as they have enough money to pay that off, everything else goes to the stockholders.
Got it. Okay, so now let's fast forward 2022, right? Here we have this relationship, theoretically, that, hey, as long as you have stocks and bonds, you're well diversified. If one goes down, the other one goes up, and you're good, right? Well, we certainly saw in 2022 that didn't happen. In fact, for those of you who may have been watching very closely that year, there was a point in time where bonds were down more than stocks. So what's going on, Brad? Why did that happen?
Yeah, I think the natural kind of logical relationship that you would think of between stocks and bonds is inverse, right? When stock prices rise, bonds fall, and vice versa. When stocks are rising, it's because investors are buying stocks, right? So where do they get the money to buy the stocks? They sell something else. So nobody wants they're selling their bonds to buy stocks.
And if I may interject, that's basically what we saw a lot of, when interest rates were near zero, right?
Yeah.
They're like, why? I don't want to get 1% when I can at least get a dividend of 2 or
Right.
2.5.
Yeah.
Go ahead. Sorry.
No, that's right. So oppositely, if stocks are falling, it could be that stocks are out of favor, and you can have this flight to quality, where investors are leaving what they perceive as a more volatile stock market to buy this quote unquote safer bond, right? So you would see the opposite, kind of sell one to buy the other effect.
So it's a supply and demand thing.
I think that's certainly one of the, I think if you
Factors.
think of fund flows, right, to buy something, you have to sell something else.
Mm-hmm.
And there are other asset classes, right? I mean, we could go, farther into the weeds, but obviously bonds and stocks are the two big ones. But it gets more complicated when you think of cash and private investments and things like that, debt that you could take on. That makes it a little complicated, but usually to buy something, you have to sell something else.
Excellent.
So I think this inverse relationship historically can provide great diversification, right? If you have these offsetting returns in your portfolio. So I think that's been historically the comfort in that relationship is that you can kind of, without getting too much into the weeds of portfolio volatility, you can, if you have multiple assets, you get the weighted average return of those two things, but you could actually have less than the weighted average volatility of those two things if they have a negative relationship and kind of offset each other a little bit. So your return doesn't suffer, but your volatility can be significantly less.
So basically, when I hear that in English, that kind of tells me you're losing less when things are bad in the market, and therefore you are going to recover much faster.
Yeah, that's the other side of it too, right? If your portfolio trades within a narrower range, we could kind of get into the difference between a mean and a geometric mean rate of return. But yeah, I think
that's why they pay us the big bucks, right? To differentiate.
Yeah, if you can reduce the downside, all else equal,
right?
I think you're better off long term. Yeah.
Very good, very good. Okay, so we understand how that relationship and at least the theory. What's happened? What has been happening in the last few years in terms of that relationship? Because they sure don't seem to be providing as much diversification benefit.
Yeah, so I think we've really only talked about this idea that the only appeal to bonds and stocks is like the non-appeal of the other one, right? And there's just a lot more to it than that. I think you have this comparison effect where the appeal of stocks is based on bonds not being appealing, or the other way around. Maybe I'm nervous about stocks, so I'll buy bonds instead. But that's just like such a small part of what prices react to. There's so many other things at play that determine whether the appeal of stocks or bonds exists other than just each other. I think in a recent case, it's probably more inflation, right? And a rapid increase in interest rates that cause them to start moving together, not necessarily the characteristics of each other. There's this third thing at play to kind of distort that, what we think of as kind of the normal historical relationship.
Okay, so let's explain to everybody listening what happens when inflation begins to tick up, right? It peaked at 9.1. What happens? Why is inflation the thing that both stocks and bonds don't like?
Yeah, so I think, when you have this normal kind of low inflation, right, which is, I think, kind of the 0 to 2.5% inflation is kind of the normal operation of things, right? Stocks can grow under a predictable, stable inflation regime. Bonds will, continue to pay interest and coupons and things like that. But there's almost like the kind of this hurdle, when it's almost maybe sentiment driven, but you get to this point where inflation seems too high, right? And then things start to act a little funny. And in the case of 2022, in response to higher inflation, the Fed and central banks everywhere started raising rates fairly rapidly, which is bad for bonds, right? There's a way more predictable relationship than between stocks and bonds is between bond prices and interest rates.
Right.
You know, that almost never fails. And so if rates are higher, bond prices will drop. And I think for stocks, got to this point where, you know, I think stocks can handle a little bit of inflation because as long as wages of the people that are buying the stuff are earning incomes or they're growing incomes fast enough to offset the increasing cost to companies to provide the things that they want to buy, right?
Yep.
Like, so the company's expenses are rising, but consumers' incomes are rising too, so they kind of could sell the same amount of stuff.
Right.
If wages aren't rising and the cost of production is rising rapidly due to inflation, and then, you know, so you've got that part of it, but then you also have all the debt on their balance sheet is being rewritten at higher and higher rates. Stocks don't look great either. So now you have this time in 2022 where both really, really got whacked at the same time.
Okay, so since we're doing fundamentals, let's you and I do kind of a role play. And by the way, we didn't practice this, so we're going to pretend.
We'll give it a shot. Yeah.
Okay, give it a shot. Let's assume that you hold a bond. Pretend it's $100,000.
Right.
Okay, you want to sell it, you need to sell it, whatever. Okay. Let's assume also that I want to buy a bond, and I got this wonderful $100,000. I got an inheritance, whatever.
Yep.
Okay. Now, let's assume that your bond is paying 3%, and new interest rates have risen to 5%. Right?
Yep.
So now I have one of two choices, right? I could buy your bond, $100,000. For the next 30 years, I'm going to get 3%. Or, because it's a market, I can choose to get a new bond from that same company or municipality or whatever and get 5%. Hey, it's America. What do you think I'm going to do?
Yeah. Yeah, my only choice as the holder of the bond would be to reduce the price of it until it's appealing to you, right? And then the interest rates would kind of equal out.
Okay, for the record, $90,000. I'm not buying it for 90, so you got to go lower, right?
Well,
all right. Yeah.
Yeah,
See, that's the thing. It's a market. It's one
Right.
of those things where we go back and forth. So Brad, in that example, has to figure out how much does he have to lower the price of his bond to entice me to buy it at that lower price, knowing that I'm only going to get the 3% per year.
Yeah.
So,
because in reality, I could do the same thing. I could take your $90,000 that you give me and then go back out and buy a $90,000 bond at the
Right.
new interest rates
and that's why they're
and
traded
probably
so much.
just go back to the same place I would have been anyway.
Right. And what's the most important thing? Let's tell our listeners when you're looking at bonds, individual bonds, or what a bond manager. It's not the coupon, which is in English. It's the yield. It's the yield to maturity, right?
Right.
It's math. This is one area of the market that math is math is math.
Yeah.
Right?
Yep.
And there are other factors, you know, is it insured, yada, yada, yada. But so now we understand why prices for an existing bond go down when interest rates go up. And then in the stock market, because the stock market isn't just looking at earnings today, right? They're looking at, well, what are their earnings going to be next quarter and next year and yada, yada. And the CEOs of their companies don't even know, right?
Yeah.
So they kind of figure it out and say, okay, interest rates are higher, then their earnings are going to be lower as a result. So I don't want to pay so much for this stock.
Right.
And they sell it.
Yeah.
And again, when I'm talking about it's mostly institutional investors that are doing their, calculations. Okay, so now we get it. So 2022, they both went down. Fast forward, here we are in this new interest rate environment. We can question the benefits of diversification in stocks and bonds. Let's talk about that. Should we bother? Should we even bother?
Yeah, I think so. I think whether something is very minimally positively correlated, like to say something as a 0.1 correlation, correlations run from -1 to +1, right? Perfectly opposite all the way to perfectly in line. So something that's like 0.2 correlation is a little bit correlated.
Right.
The difference between 0.2 and 0.1 and like -0.1 is is kind of subtle, right?
Yeah.
And I think there are still tremendous diversification benefits to being just a little bit correlated. I think in reality, to find something that's negatively correlated to the S&P is extremely difficult. There's almost nothing. I think commodities, over the last decade, maybe commodities, cash, and like managed futures are the only ones with actual negative opposite correlation.
So in English, and I keep on saying that, Brett, I know you speak English, but I need real basic English. So basically, what I'm hearing is they are correlated, positive or negative. So if stocks are going nuts, the other thing isn't doing so hot. And then if stocks are losing money, this one's up, right?
Yeah,
negatively.
I guess that's, well, so
but
that's
there's nothing that is perfectly negatively correlated. And by the way, we probably don't want that anyway, right?
Well, that's what I was going to say. I don't think the appeal of negative correlation is not even that great to me, because we could have things that totally offset each other all the time and guarantee that we never make any money at all.
Right.
You wouldn't lose any, but you also wouldn't make any. So what's to have a perfect offset? We could buy the S&P and immediately sell calls at the same place and just guarantee very little money, and we would have two things that had negative correlation. So I'm not sure that that's really the appeal, but I think in terms of stocks and bonds, even if they're slightly positively correlated, it still gives you the tremendous benefits in terms of moderating returns, right? If the S&P's down 10 and your bonds are down 2, then and you're a 50-50 investor, your portfolio is only down 6.
Excellent.
So sure, they both moved in the same direction, but just not as drastically, and so you've kind of
Smooth
put your return in between those two extremes.
Excellent. Okay, so let's go. All right, we are where we are. What do you think going forward? We're here to, advise people about, and I'm going to timestamp this. This is what, June 5th of 2024. Yep. We are in this kind of stable kind of interest rate environment. The Fed hasn't really done anything quite yet. What do you think investors should do in an environment like this, whether we are, and we could talk a little bit about, a hard landing, soft landing, or no landing at all. Let's do that. Okay,
yeah,
so people are hearing that, Brad, and I think we should just put it out there and say, all right, this is basically what they're saying.
Yeah, so I think that will probably define the relationship between stocks and bonds going forward, is like which one of those it ends up being, right?
Excellent.
Whether it's hard, soft, or no landing at all. I think if you and the probabilities are evolving. So your original question of what you should do about it, how much are you willing to bet on one thing or the other happening? I think you want to be prepared no matter which one happens. Again, major institutions are have a lot of money on the line. They would like to know which of those things is going to happen, and they want to assign probabilities to that and have insurance and hedging one way or the other. But I think for most of us as regular investors, I think, what can we do that make sure that we're okay no matter which of those happens, and we don't have to be so dependent on making a bet on one of those things or the other.
Especially because people who are making strong bets one way or the other at the beginning of this year were probably wrong, right? Everybody was saying interest rates were going to go down by now, yada, yada, yada. And getting back to this hard landing concept, a hard landing is, and it sounds like we're flying planes, right? But basically, it's a hard landing. In other words, they're talking about the economy and GDP. And a hard landing would be if we are headed for or in a recession. I don't know if I told you this, but I heard something today, and I wish I could give the woman credit, but historically at least, when a recession occurred during a tightening cycle or after a tightening cycle, historically that recession started 10 quarters after the first rate hike. And what that would mean in today's environment is, okay, if we were going to do the average, we're headed for a recession in the fourth quarter of this year. Okay, so go figure. So a hard landing is a recession, that the economy really suffers, unemployment goes up, people are losing their job, et cetera. And the headlines and people are freaking out, right?
Yep.
Okay. So what's a soft landing?
I think a soft landing is the Fed or whatever central bank just has the perfect speed of raising rates, right, to try to slow down the economy. that the economy slows down at a reasonable pace without going so far as to have those same problems, right? You get inflation into the range that you're comfortable with without creating the job loss, without spiking interest rates so high so quickly that companies have a hard time paying their debt off. That's when you have problems, like you said, in the hard landing, and you would head into recession. You can avoid a recession, or you would have maybe a very mild recession in the event of a soft landing. I don't think anybody officially defines a soft versus hard landing. I think it's more of like guideposts for how to think of the extreme nature of it.
It's interesting. I think the first time I heard about soft landing was when Alan Greenspan was the Federal Reserve chairman, and he got us, where he wanted us to be without putting us into a recession.
Yeah.
So that's interesting. Okay, so now what's this no landing scenario?
Yeah. So no landing, I guess, would be you somehow have this drift toward the inflation number that you would like to have, but it goes very slowly and almost kind of stagnates at a level that's probably a little higher than what you would have wanted, but not so high that you're willing to continue to raise interest rates to get down to where you're at. I think you've almost you've done most of it, right, to get inflation down from 6, 7, the really lofty numbers, down to, you said you wanted it around 2, but what if it stops at 2.5 or 3? Do you say, all right, how much do we care about this last 0.5%? The economy's still growing, albeit slowly, but it's growing. Are we willing to stop that to get rid of the last 0.5% of inflation? I think, you've got this real last bit of the decision there. You've done most of it.
Right.
How far are you willing to just get the rest
And that's
of
really been the argument recently, because inflation peaked at 9.1, and, they got it down. They raised like crazy so fast, and markets crashed because they thought, oh, for sure, we've never seen them do this quickly. Here we are, inflation's, it started, it got down as low as 3%. More recently, it's been about 3-4, and they haven't done anything. And it's, the Federal Reserve is data dependent. That's what they keep on saying. Yeah. So what I'm hearing, and what I think we're all hearing, is, well, maybe the Fed is going to be okay. Maybe they're going to change that target from that 2%, fixed in stone. Maybe they're okay with 3%, right? Especially since it's an election year. I think it's also interesting, especially because it's an election year, you're hearing these rumors of the Fed, are they really independent, yada, yada, yada. And if they cut rates in, for example, September, what are the optics of that? Right? Yeah. So, given that backdrop, and because every time is going to be different, nobody can predict, it is an election year, given their role as independent, given the fact that, we're doing okay. We may be growing slower, but people aren't losing their jobs left and right, which is the big thing, right? Yep. These are families. I mean, this affects people. Yeah. So maybe they'll just keep it the way they are. So given that, okay, let's boil this down. Yeah. What are we telling our clients? What do we tell people who are listening today?
Yeah. So if that's the way it ended up being, how does that flow through to stocks and bonds? I think we would live in a world where interest rates stayed higher than certainly what they've been for the past 15 years, right? You would have, so I think knowing that you were going to have higher rates for a longer period of time, I think in a lot of ways, the longer end of the bond curve has been largely unaffected. I mean, it's been affected, but not quite like the short end, right? But if you thought that rates were going to last longer, maybe there's now more of the natural upward sloping yield curve, right? As longer term debt gets rewritten at higher rates, thinking that it might stay. Because there's kind of been this real unwillingness to commit to borrowing at higher rates, because I think everybody's believed that rates won't stay up that high. So I don't want to borrow at 6% right now, knowing that in a couple years from now, I can borrow at 4.5.
Which is very interesting. I'm glad you said that, because that's affecting the housing market, right? People don't want to go out and sell their home and get a mortgage and pay 7+%. So they're not doing that. Yeah. Again, this is where the concept of a market really becomes powerful, and the implications. The long end of the curve, you mentioned that. Now, when we think about that, Brad, the longer term rates, meaning for a 30-year bond, for a 20-year bond, those are long term. What's kind of weird right now is they're actually paying less, or the long end is you get lower interest rate than the short end.
Yeah.
So the Federal Reserve, again, just to kind of bring it home, they manage or they influence the short-term bonds, right? The long-term bonds is the bond market. Again, opinions. What do we think bonds interest rates are going to be in the future?
The expectation of future short-term returns, right?
Yeah.
Like you could look at a bond, a 20-year bond, as a chain of linked 1-year bonds between now and then, right? So if you have these, the short end of that is very high, but then you expect, the next 17 years to be fairly low. That blended out is something lower than what they are today. So you have this expectation kind of theory that if we all believe that rates are going to drop, long-term debt certainly can be cheaper than short-term debt. But this kind of no landing scenario would theoretically lengthen this beginning period of higher rates, and then maybe you'd see longer-term rates adjust accordingly, and maybe that fixes it. Maybe all the people that were sitting on the side of not willing to buy a house at 7% have to just hold their nose and do it, because 3 years from now it might be the same thing.
Right. That's exactly right. And for those of us, and I'm showing my lines in the middle of my forehead here, there have been many periods of time during our history where interest rates were much higher for a long period of time. So it's not the worst thing that could happen if they did stay higher from an economic and a stock market performance and a bond market performance. Historically, at least, if you look at the math of things, when you look at long-term average annual returns, the rate of return that you get on that bond piece tends to be about the interest rate in the environment in which you invested,
When
right?
you started, yeah.
Yeah, so that, to me, understanding, and we all know, we're looking at things holistically, and we're going to tie this together in terms of, what do we think is going to happen this year, next year, et cetera. What really matters? Nobody really knows what's going to happen. So what are we going to do about it? We got to look at this holistically to figure out when are people going to need the money? That's what really is the question, right?
Yeah. So I think we've been talking about this relationship between stocks and bonds as if, in a general sense, that's the only thing that matters. But the relationship of different types of bonds to each other can be very different, and the relationship between different kinds of stocks to each other can be very different. If we're the difference between how we would handle this for somebody that's adding to their portfolio, accumulating assets that's 35 years old and is 35 years from retirement. The way they would combat inflation is totally different than somebody that's taking cash out on a monthly basis.
And that's the biggest risk we have, isn't it? The inflation risk. There's a reason why the Federal Reserve is they're kind of really hyper focused on inflation, because it really hurts people.
Yeah,
it really does. And that's the biggest risk that investors have, in terms of they've got to make sure that whatever they're doing increases at least the rate of inflation after they pay their taxes, right? So that their rates of returns, the purchasing power of that dollar, remains about the same. Ideally, it's going to grow. So, a dollar becomes $2. That's the whole point of accepting the volatility of stocks. You hope that it's going to work for you and grow in value after inflation and taxes.
Right.
That's the goal.
Yeah, otherwise you don't want to, there's no reason to do it.
Right. And I'm going to end with this, because we're just talking about stocks and bonds, but, hey, 5.3% on an institutional money market account that we're getting right now, and that's not bad. Why not just do that?
Yeah, well, so I think that's a valuable tool for that group that is taking money out right now, right? Again, the relationship to stocks and bonds is not as important for somebody like that, because we're more worried about the relationship just around interest rates itself, right? Cash and short-term bonds will respond very quickly to increases in interest rates, and the same as they will decreases in interest rates. So, we want to have, things available they need money next month.
Right.
We need to make sure that thing is available next month.
Irrespective of what somebody's saying on TV, right?
Right, yeah.
And by the way, the other thing I heard this morning, another opinion on one of these talking head shows, they think that interest rates are going to go up after the election. Not go down, go up.
Yeah.
So, it's all across the board.
Mm-hmm.
And when people are talking about this stuff, it sounds so rational. It makes so much sense. Yeah, I could see that happening. Well, just goes to show you nobody really knows. So we want to be prepared for anything, which is why that cash bucket makes so much sense for people who really know that they're going to need the money for retirement, tuition, whatever the case may be.
Yeah.
Excellent. So relationship between stocks and bonds really hasn't changed that much. It never really was a perfectly negative. It's
Right.
just that, one may lose less or earn more than the other,
Yep.
right? So that's been historically, and that hasn't changed.
Yeah, I think actually the positive relationship is more historically common than the negative relationship.
Right. It's in the third. Yeah. It's the negative correlation has really happened over only like 31% of the time in the history of the market. So this is more normal than people realize.
Yeah.
And I thought your point about, within that asset class, there's lots of different types of bonds, right?
Yep.
And there's lots of different types of stocks. This year is a perfect example. You got the Magnificent Seven, setting records and going nuts, and now they're growing at 30, 40, 100%.
Mm-hmm.
Whereas the rest of the market's not doing so hot, right? But they're making money. They've got their earnings, et cetera. So nobody wants to invest in them, but they may be good values, right?
Right.
And then the bond market, a lot of people say, oh, why not just buy a bond, buy a treasury? And people can do that. But boy, sometimes there's a lot of value to having that actively managed, even more so than maybe stocks.
Sure.
So because there's so many different kinds and so many different things to consider, not just interest rates.
Right.
Excellent. So if I hear you right, what you're saying is, okay, fine and dandy, we're going to have whatever we have this year. Nobody knows what's going to happen. There's a lot of talk both ways. Interest rates are going to go up. Interest rates are going to go down. The economy seems to be humming along just fine, thank you. The Federal Reserve doesn't seem to be in a rush to do one thing or the other. And the most important thing that people listening today that they need to consider is what? Fill in the blank.
Well, I think we almost end every conversation talking about how it comes down to an individual's plan and cash flow.
Yeah.
I think it's just that alone, I think, is the first place in determining what asset allocation is appropriate, right?
Okay, so I'm going to get on my soapbox here, as you well know. So really the key here is what your financial plan is saying and when are you going to need the money and what are you comfortable with? What's not just your risk tolerance, but your capacity to accept the risk without putting yourself in a position where you could run out of money.
Yeah, and then within that overall framework of, 100% equities to zero bonds or 50-50 or 70-30 or whatever it is, we on our side want to, figure out what the risks are and, are they likely or are they unlikely? But then what would we do, to prepare for any of those things happening?
Excellent. And basically what you hear me say a million times here, and that is I want to understand what's going to make that family fail. I want to understand where they are vulnerable. You got to run the numbers. There's no guessing. You can't guess on this stuff. It's just too important.
Yeah.
Because you know what? We don't want a client, and we don't want anybody listening today to do something and then be 75 years old and look back and say, I wish I hadn't.
Right.
And nobody knows what's going to happen in the future, so you just run the models. What if this happened? What if that happened? That's stress testing.
Yeah.
So that we understand at least in advance what their capacity is to accept whatever that thing might have been. Right. Whether it be inflation, whether it be higher taxes, whether it be this or that, somebody getting sick, things of that nature. It's those cash flow surprises, I think, that people are often surprised how impactful that really is on their portfolio and the decisions that we make, right? So, anything else?
I think that's it.
Okay, sorry for my soapbox, Brad. You know me. I do tend to get on my soapbox there. It's just so important, I think.
Yeah, absolutely.
And I know you have too. You've had those conversations with clients. So, Thank you so much for joining me, Brad. This was really fun.
Yeah, thanks,
Again,
Brad.
it was fundamentals. We did get into the weeds a little bit. Hopefully, there's something here for everybody. And mostly thanks to all of you for listening to Brad and I for 45 minutes as we talked about the fundamentals, stocks and bonds, and even cash, how they work. Is the, traditional relationship between the two completely broken, never to be seen again? And most importantly, what should you do about it, especially in this calendar year? What changes should you be considering? Thank you so much for joining us today. I'm Patty Brennan. Brad Everett, you are the best. Thank you so much for joining me today. This was fun. And thank you. And if you have any questions about this or any other topic, please feel free to go to our website at www.keyfinancialinc.com. And even more importantly, on this day, June 5th, 2024, I hope you have a great summer. Take care.